You are holding money that is disappearing, not stolen, not taxed, not printed away overnight. It is vanishing through a mechanism most people never see. A mechanism that does not announce itself. A mechanism governments have used before. A mechanism that works quietly. Between 2021 and 2023, something unusual happened to bond owners. You bought a U.S. Treasury bond in January 2021. 10-year maturity. It paid 1.1% annual interest. Safe, predictable. You received your interest payments every 6 months, exactly as promised. But something else happened in those 2 years. Your bond paid 1.1%. The numbers on the statement looked correct. And yet you lost 4.9% of your money per year. On a $10,000 bond, you lost $490 per year in purchasing power. For 2 years, that is $980. Gone. The government paid you interest, but what they paid was worth less. Much less. Wait, if you lost $980, where did it go? The answer is not obvious. The government borrowed $10,000 from you in 2021. In 2031, they will return $10,000. The numbers will match. Every dollar accounted for. On paper, nothing changes. The statements look identical. And yet, you are worse off. Much worse. But the contract is fulfilled. Here is what most people do not know. This same mechanism was used to reduce government debt after World War II, more than taxes and spending cuts combined. The United States ended World War II with debt at 106% of GDP, $260 billion in 1946. Everyone expected decades of tax increases, austerity, painful cuts. But by 1974, the debt-to-GDP ratio had fallen to 23%, an 83 percentage point decline in 28 years. The nominal debt did not fall. It rose from $260 billion to $492 billion. The government did not pay it off. It made it smaller without reducing the number. Between 1945 and 1980, real interest rates on U.S. government debt were negative in roughly half of all years. The government paid bondholders interest, but inflation ran higher. 2 economists later measured the effect. Negative real interest rates reduced U.S. government debt by 3 to 4% of GDP per year. Every year. For 35 years. Over the full period, the United States reduced its debt burden by 90 percentage points of GDP through this mechanism alone. Britain followed the same path. Debt peaked at 238% of GDP in 1947. By 1980, it stood at 43%. Real returns averaged negative 2% per year. France experienced negative real rates of 3 to 4% in some years. Italy, Australia, Japan. Every major post-war debtor followed the same structure. Trillions in debt. Erased. Not through taxation, not through default, through time, and no one voted on it. But wait, if bondholders lose, why did they keep buying? Because exit was restricted. Governments do not just set interest rates below inflation. They restrict alternatives. They build a regulatory cage. First, banks are required to hold government bonds, reserve requirements, capital regulations. In the 1950s and 60s, government bonds were treated as zero-risk assets. Negative real returns did not matter. Second, pension funds face restrictions on foreign investment. Capital controls prevent moving money abroad. Britain maintained exchange controls until 1979. France until the 1980s. Japan until 1984. Third, deposit interest rates are capped. In the United States, this was Regulation Q. The government told banks, you cannot pay depositors more than a fixes rate, and that rate was always below inflation. You walk into a bank in 1965. Savings account offers 3%. Inflation is 4%. You ask for more. The banker says, I am not allowed. You could hold cash, but cash earns zero. Inflation erodes it. You could buy foreign bonds. Capital controls block that. You could buy real assets, real estate, stocks, commodities. Some did. Asset prices rose sharply, but most people kept savings in banks and bonds because regulated systems limit choices, not understanding. Picture this. A public school teacher in Ohio retires in 1955. She has $20,000. She buys government bonds paying 3%. Over 20 years, she receives $12,000 in interest. The bonds mature in 1975. She gets $20,000 back. Total, $32,000. But inflation averaged 4%. The dollar lost half its value. Her $32,000 in 1975 buys what $16,000 bought in 1955. She started with $20,000 in 1955 purchasing power. She ended with $16,000. She lost $4,000, 20% of her savings. No tax bill, no announcement, no default. The government borrowed in 1955. It repaid in 1975 with money worth half as much. The math is perfect. The process is quiet. This is happening again. Right now. U.S. government debt stands at 122% of GDP in 2024, higher than 1946. From 2021 through 2023, inflation in the United States averaged 6% annually. 10-year Treasury yields averaged 2.5%. Real return, negative 3.5% per year. On a $100,000 bond portfolio, you lost $3,500 per year in purchasing power. For 3 years. That is $10,500. Europe ran the same playbook. The ECB held rates near zero while inflation spiked to 10%. Savers lost purchasing power at rates not seen since the 1970s. This alignment was deliberate. When debt reaches a certain level, governments face 4 options: raise taxes, cut spending, default, or inflate. 3 are political suicide. 1 is invisible. The mechanism only works if it runs long enough. 1 year of negative real rates, limited impact. 5 years, a 15 to 20% wealth transfer. 10 years, 30 to 40%. 20 years? That is how you erase half a debt burden without a single vote. The United States ran this for 35 years after World War II. Debt to GDP fell from 106% to 23%. The arithmetic does not change. Debt at 122% of GDP, inflation at 4%, bond yields at 2%, negative 2% real return per year. Run that for 20 years. The debt to GDP ratio falls by 40 percentage points, and savers lose 40% of their bond holdings in real terms. Why do people keep buying government bonds if returns are negative? Because alternatives are constrained. Central banks buy the bonds if private investors will not. Quantitative easing. The Fed. The ECB. The Bank of Japan. Trillions purchased. Rates held down. Banks are required to hold government bonds. Pension funds face limits. And when inflation spikes, central banks raise rates slowly. Always slower than inflation. The gap persists. The mechanism runs. Most people notice only at the end, when they retire and realize their savings buy less than expected. This is not hidden. Economists publish the data. Central bankers acknowledge it. The numbers are public. What is scarce is attention. It requires tracking real versus nominal returns, watching inflation and interest rates over time, seeing the system rather than the transaction. Most people do not do that. They see, I bought a bond. I received interest. I got my money back. They do not see, I bought in $2021. I received interest in $2023. I got principal back in $2031. Each worth less than the last. The government pays exactly what it promised. The unit changes. The effect accumulates. In 1951, the Treasury and the Federal Reserve reached an accord. bond pegs ended. The Fed gained independence. The mechanism continued anyway. Interest rates stayed below inflation for 3 more decades. It did not require a peg. It required time. Washington, D.C. February 2026. The Treasury is still there. The Fed is still there. The debt is still there. And the gap between interest rates and inflation? Still there. Different decade, different officials, same structure. The arithmetic has not changed.